Okay, Tim Phillips, Zal Divitri, welcome to A to Z.
Thanks for having me.
Thank you so much.
So, before we get started, Zubin does this, but he's sitting on a boat in the Caribbean. So, I'm going to have to read this out because I think we're going to talk a lot about investing and investment approaches and strategies. So, I think it's important more now today, more than many times, to read out a little disclaimer from us, right? So, everything here is for information and entertainment only. Our views are our own. They're not those for anybody who we work with. So everything here is for information and entertainment only. Our views are our own, not those of anybody who we work with. And none of this is financial advice. Fair warning, there's a real amount of investment talk in this that we usually get to. You just need to be careful and not take advice from three guys one of whom is jet lagging and the other two who are raring to go. So fair warning, choose your investments properly. Blah 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 blah. I'm gonna do this again. I'll do this later, right?
Okay.
Tim, you have a delightfully confusing passport, right? So British father, mother from Hong Kong, raised in Hong Kong. A-levels at the Island School in Hong Kong, Mandarin in Beijing. What was it? History at Leeds?
History at Leeds, yeah.
And then somehow you wash up in Singapore.
Yeah.
Zal was sort of amazingly may even top that, right? So he comes from a Parsi family, so professional migrants, unlike amateurs like us. Father who had a storied career at Philip Morris, which meant that you lived in departure lounges around the world. Went to school in Massachusetts, then Georgetown, then Columbia. And yes, again, here in Singapore. And we all ended up working for the same firm once upon a time. So, Tim, in your words, what is it that you do nowadays?
I create financial content for educational purposes, and I think I really identified a gap in the market for just measured, responsible investing content that really focuses on stuff that is simple. It's just boring. Investing shouldn't be something that's really exciting, but all the content out there right now tries to tell you that it needs to be exciting. It needs to be massive gains, but the slow and steady, the boring stuff wins. So I wanted to take that message that I had sort of learned over the years in finance and try and bring that to the mass market, because I think anyone can invest well. They just need to have the right mindset, the right approach, and the consistency to do it.
So you're chasing boring on the internet. You joined Avastar this year. Who are they and what made you join?
Avastar is a global multifamily office headquartered in New York, and we have offices in India and Singapore as well. We cater to ultra high net worth individuals who typically have complex multi-jurisdictional lives, families, money, etc.
Yeah.
So we really help them manage their investments across the spectrum while also keeping a keen eye on their tax and estate planning needs, their legacy planning, really the full gamut of their lives.
Awesome. So before we jump into talking about, one of the favorite instruments of modern times, mutual funds, I wanted to just do a quick history lesson because we love history on the show almost as much as we love technology. And I know you do too, Zal. So in 1868 in London, there's a guy called Philip Rose. And I found this out in our research. He he launched the Foreign and Colonial Government Trust. The pitch was straight from the prospectus, is to give investors moderate means the same advantage as large capitalists. 18 bonds in there, no more than a tenth in any one stock. And the whole industry written down that year was before the Suez Canal sort of started. Fast forward to 1924, Boston, Massachusetts Investors Trust. Fast forward further, 1970, the pension died essentially. You got your own portfolio. Somebody didn't look after it for you. 1975, or was it? I think it was. When was it? Jack Bogle. 1976. Jack Bogle there's a really great podcast on Acquired about Vanguard and creating passive investment from scratch. 10 years later, State Street joins the party with SPY. They had to rebrand from Spires because it sounded like a weapon, apparently. And then 2 years ago, in 2024, the industry flipped. Passive investing overtook equity mutual funds. Today, 21 trillion in passive and 18 trillion in mutual funds. Right, this tide is really changing.
Absolutely.
We grew up in the mutual funds industry, or at least many of us did. Your reaction to this sort of change?
Well, look, Aman. I mean, I think that the passive wave has really been irresistible, and I think it's been irresistible for 2 reasons. One is, passive vehicles and investment products are typically lower in cost than actively managed products, and their performance has been just as good, if not better. So, bottom line, net returns from passive investing have been, for the most part, better than active in many categories. Of course, there are exceptions.
Yeah.
There are exceptions where active does outperform, but in many categories, passive has done better, and the money goes where the performance is better.
So we on the show talk about 5 primitives in financial services, predominantly in banking. Essentially, banks do 5 things for you. They help you see your money, move your money, borrow your money, and protect your money. But the one thing that they do, which both of you talk a lot about, is grow your money. That's sort of that's the combination of hope and greed, right? Like the other stuff is just hoping that you don't lose it. Greed, you guys sort of help people manage, what they want to be and where they want to go. Tim, somebody comes to you with $100,000.
Yeah.
It's half their net worth.
Yeah.
And they've been sitting in fixed deposits. How do you walk us through how you would explain they go about, getting off that and getting on to presumably a different escalator?
I think first off, you kind of have to establish that every individual is going to have a different risk appetite, a different investing time horizon as well. So if they are going to be investing for the next 20 to 30 years, that should be going into equities, right? Effectively. But you have to be aware of people who are in their late 40s, 50s, approaching retirement, and sequence of returns risk, et cetera, et cetera. There are lots of things to consider. So I can't just say, this is a one size fits all, just go out and lump sum it and buy, global equities if you're an ETF. But for someone young, that's pretty much what the data says you should do. Because if you lump sum it, technically that beats dollar cost averaging 2/3 of the time.
How young is young?
Someone in their mid-20s, 30s. I'd say if you're thinking about your time horizon, there's never been a negative 20-year return on a rolling returns basis for the S&P 500. So if you're thinking about the worst periods, yes, 2000 to 2009, it was negative. In the sort of 80s, there was a negative period. But if you're thinking about 20-year rolling returns, never been a negative period in the history of the S&P 500. So you can use global equities as a proxy for that. It'll be positive. So if you've got at least 20 years...
There have been dry spells, right?
There have been dry
flat
spells.
lines.
Yeah, there have been dry spells. But I think timing the market or trying to second guess when that dry spell is going to be is just a fool's errand, basically. There's no point in anyone trying to do that. But you have to be responsible in how you approach allocating it when you're older. So because of sequence returns risk. So I think there are lots of things to consider. But for someone young with 20 years ahead of them, that really should just go into a global equities low-cost ETF and then just leave it.
So let's take that and let's go to Zal on this. Just asking for a friend. Somebody who comes to you saying they're got close to 10 mil, they're in their 50s. They've been massively, maybe not fixed deposits. They're hugely into bonds, but they need a little bit more yield. They want to kind of retire in 10 years' time. How do you work with them?
Well, what I'd say, Aman, is first of all, we begin with the first frame that Tim just talked about.
Okay.
Understand the client's investment time horizon, understand their risk tolerance, what their goals may be, what their needs for cash in the next couple of years may be.
Yeah.
And once we've done that, we then go to our second layer, which is really understanding their tax and estate planning needs, as well as where they are now and how we can optimize that.
Yeah.
So for our strata of clients, that's a very important analysis to do. Once we understand really where your tax and estate planning needs are, we then establish a plan for you, and only then do we actually place your assets into the right structures given that plan. So when we take that multi-stage process to investing for our clients, we really allow their money to grow well and grow most optimally.
Yeah.
The final step we take is really choosing the actual instruments that go into each asset class.
Yeah.
And here we may use some active and we may use some passive depending on the market.
So, but I mean, if you're in the same situation, but
Yeah.
you don't have 10, you have $1 million, right?
Yeah.
You kind of screwed.
No.
Okay.
Not at
How
all.
would you? So,
I
but
mean, I think-
no.
No.
They're not gonna. They're not gonna have access to.
I mean, I like to say this a lot when we talk about ultra high net worth. I mean, I think people in their hundreds of millions, maybe they have a lot of tax, as Zal was saying, like cross-border issues that they have to
Trust
think about, trust
businesses.
businesses, and cross-border tax
Yeah.
liability. So those are things that I think you really need to think about. For 99% of the people who have maybe like even 5 mil, 10 mil, and they have one tax residency, they don't need to overthink it and overcomplicate it. I think this is what we'll get onto later. But a lot of the products that are out there, they use complexity to disguise high fees. I always like to say this with investment products: complexity equals high fees in disguise. That is what it is. Because usually there's a story to tell, there's a narrative to weave to tell you this is what you need, and I'm going to tell you why. And
Yeah.
then I'm going to weave a whole story.
But is that
around it.
true? Is that true at the bottom of the pyramid and the middle of the pyramid? I mean,
It's true throughout, I'd say. I mean,
Okay.
if you're an accredited investor in Singapore, I always say this: don't announce it. Don't tell people. Don't tell your bank that you're an accredited investor, because all you're going to get pitched to you is worse products than you're going to
Leverage.
get. Yeah, leverage, structured products, things that are not going to outperform a global equities index tracker over 10, 20 years, pretty much. And so for me, it's always simplicity equals optimal returns.
But is that true? Like, I'll give you an example. Right now, there's this trade. They're calling it the Indian carry trade. You,
right.
you know what I'm talking about?
Absolutely.
So essentially, are you familiar with this?
No, but tell me the story. I want to hear the narrative.
Actually, why don't you explain what the?
Okay, look, from time to time, the Indian government, the Reserve Bank of India, feels that the country needs foreign exchange. And there are episodic periods during which, because they need foreign exchange, they actually give very attractive deposit rates to non-resident Indians. So these
like
may be
6%
Yeah.
on the U.S. dollar.
these may be Indians living abroad, etc. And these are actually not bonds; these are literally fixed deposits.
Yeah. It's like,
Or
it's like the yen.
CDs.
It's like the yen dollar carry
Exactly.
trade, right? Pretty much. It's just with Indian.
And
like-
you can
Yeah.
lock in your tenure, and you can actually get pretty attractive leverage from
Yeah.
banks because they understand. Look, these are Indian banks; these are
Yeah,
fixed
it's like up
deposits.
to 9 times.
Yeah.
Yes, in this case, these are very
To
episodic.
give you like a 15% yield from what
You're
I
right.
what
And-
somebody was.
what's the incentive?
What's the incentive for it?
So
From the bank's perspective.
The banks. For the bank, it's a bit of a foolproof deal because it's
Because they
government
get-
backed, right?
But,
It's
no,
like
but I'm saying, what is the fee incentive? This is something that we never talk about from the consumer perspective.
actually in this case
Yeah.
there is minimal fees. What the banks again, correct me if I'm wrong, and we're like
Yeah.
ganging up on you like bank gang. I mean they're getting deposits, right? They're getting tier 1 capital
Yeah.
into.
But
they're
if they're selling you leverage, surely they're getting you something from that, aren't they?
Look, I think this is a very episodic
Yeah.
case, and I think that this is a case where pretty much everyone makes money.
yeah.
Yeah.
And it's a case where the risk is relatively mitigated. You can never say there's no risk.
There's no
In this
risk.
case, the
Yeah.
banks will make money on their lending
Yeah.
spread. The clients will make, if they hold on to this for 3 years, a pretty handsome return.
Yep.
And the Indian banks will get foreign exchange. But this is a pretty unique scenario you've just painted.
I digress, but let me come back. So, Tim, let me
Yeah.
ask you
Yeah.
a really direct question, right, on this one, which is that,
Yeah.
if in gene sequencing nowadays, you can edit a gene and you can sort of stop a behavior, like
Yeah.
diabetes off.
Yeah.
Not yet there. I'll take that up when it does. But if you had to go to the banking gene and say, stop selling that product.
Yeah.
I'll come to you on that, Zal, too, I promise. What's the one product you would say, take it off the shelves?
Structured products, structured notes. So I think basically what private banks hawk a lot of, I've seen a lot of people lose a lot of money in structured notes, in structured products. And sure, there may be niche situations where it can serve a purpose for hedging, et cetera, et cetera. But on the whole, I come back to the great Charlie Munger quote, show me the incentive and I will show you the outcome. In banking, in the investment industry, it comes down to that quote. That's pretty much what it comes down to. Show me the incentive and I will show you the outcome. So things get sold.
Got you.
Why? Pricing.
Got it.
Fees. That's the one I would take off.
Okay. Zal?
Look, having spent quite a few years in the retail banking space in Singapore, I actually agree very much with what Tim just said. The product I choose is dual currency accounts or premium accounts, as they're often known. These are essentially accounts which have options embedded in them, which then give you enhanced yield, and you may then get delivered an alternative currency. I've watched clients invest in these sort of across the cycle, and invariably they lose or make very, very little money.
Yeah.
So in some respects, what you're saying is that actually it gets overcomplicated, but if they've got a good advisor, they can actually, it's a bit better. But what you're saying is that your individual investor really doesn't have anybody's incentivized. In your case, at the top end of the customer, they are actually paying for advice, and it's a cleaner relationship?
No, I think what I was saying, Aman, is there are some products that for the most part I would avoid.
Yeah.
And in this case, I actually would almost invariably, almost all the time, avoid a dual currency investing. Once in a while, it may be appropriate because you may actually want to take... But
the problem is knowing when that...
Exactly. Yeah, right. And the problem is doing it episodically and stopping.
And that brings... So this brings me to the next area that I want to go, because I'm sort of like raring to go there, is that I've worked in retail banking, private banking, and then asset management. And one of the challenges I have is as you said, Tim, the incentives. I mean, they're good people, running this. I was literally in a retail bank in India recently, and I was walking out, and the person literally came to me and said, sir, could you buy a mutual fund? I need to meet my my year-end target. It's like, I mean, that's an extreme view. I'm sticking with India, but this is true elsewhere. There is, people going to elderly parent, before this call, we had my mom calling me, who's telling me that, there's this RM is telling her to, invest in something because somebody else is doing it. How do we fix that? How do we fix that system? Because you can't have access to sort of like Zal until you've made it. Unless you become his friend, which kind of works out for some of us. How do you do that? How do you reconcile that?
I think it's education. I think first off, you have to establish that in Asia, the distribution model is really focused around banks. Like they distribute the products, and it's a very product-centric ecosystem in Asia. And I think that's just the history of the market.
Isn't the US the same?
I think the US does a lot more RIAs, like, investment advisors who give you sort of fiduciary duty to give you the best advice, et cetera, et cetera. And it's not really driven by commissions and trailer fees, but I think in Asia, the ecosystem is very much driven by that. And that's just the way that it's set up. So I think trying to change that and trying to get it through the regulatory sort of system and the political capital required to do that, it's just, there's a much bigger question to ask, right?
Whenever I talk to people in the industry, they said people in Asia don't want to pay for advice. That's something you hear again and again. So like, lie to me about the fees, but don't tell me that you're charging it to me.
But how? I mean, thinking it from a government perspective, how are you going to transition from a commission trailer driven model to fee only and have a lot of people still employed? It's a very difficult.
And so how do you
transition? So I think that's a really difficult question to ask. So I think to answer, so I think for consumers, the best you can do is really educate yourself on the options, which is part of what I'm trying to do, is just say, if you want to go to the bank and see an ILP in front of you or whatever products in front of you, that's fine. They give you their pitch, but I want to give you the pitch of the low cost pitch, the investing pitch for ETFs, because no one talks about that stuff because it doesn't make any money. if unless you're an iShares, a Vanguard, a Spider, a State Street, you're the ones who can make it because you have 10 trillion AUM and you're earning 10 basis points.
Yeah.
Everyone else, they don't make money from that system. So I think for me, it's more about education. Just be aware of the choices that are out there. Look at the data, look at the history. I'm a history guy, but I'm a data-driven guy as well. I want to understand the data behind the performance. I don't want to hear the story. I want to understand what the data tells me. You're telling me this is a great story, but what does the data show me? Net of fees, what am I getting back, right?
So is our mutual funds, I mean, we've worked in the industry, are mutual funds like a no for all use? Neither of you said mutual funds when you talked about a product you would take off the shelf, but you're sounding like it. Like, would you take a mutual fund off the shelf?
No.
Or is there a situation where are there situations where mutual funds make total sense? What are they, Tal?
In my view, in my company's view, and in my experience, markets that are very efficient, look at the U.S. large cap equity space, for instance, it's very difficult for active managers to outperform market beta, market ETF, because they're very low cost, and it's just very difficult.
And with super tight, well, for the moment, governance, so no edge.
No edge. Now, there are markets, whether they be geographic markets, where investing may be not as efficient, where they may still be edge for active management. I'll think of in India, a China, and
Indonesia on a
so
good day.
typically we look at markets like that, or we may look at some very esoteric investment
classes.
kind of strategies and asset classes where active also does make sense. But I agree with Tim, and frankly, we embrace this philosophy ourselves, that for super efficient asset classes, we actually use ETFs and market beta because that's the most optimal way for our clients to access that asset class.
Because I found it really interesting in my 1-year cameo at Schroders to realize that actually most mutual funds comprise of a large number of ETFs. They would, it was sort of like a mixologist with your ETFs. And as we said at the top of the show, not only are they sort of mixing the drinks with it, they're chugging it in many places. Zal, talk to me about private banking. You were in the wealth and private banking space prior to Schroders, with a fairly storied brand, very storied brand. How is private banking? Is private banking any different from a retail RM?
Yeah, I think that's a very fair question, Aman, and I think...
Are they just a better paid retail RM or who serves you sort of like truffle oil to virtue signal instead of take you for a burger?
That's right,
if you're good.
and get you tickets to the F1
Yeah, I mean,
race.
but again, going back to that lied to me thing, is this...
okay, so jokes aside, let's step back and take a big picture. I think if you look at the private banking model, it has been under pressure and under ongoing pressure. Margins are being squeezed.
Yeah.
The proposition that private banks could get access to very rarefied and exclusive product is no longer really the case, because there really is democratization of access to even specialized private assets.
Yeah.
The cost to serve that private banks have as well are very high.
Yeah.
So if you add all that up, the model is under pressure. Now, having said that, there are plenty of clients who actually still do benefit from private banks. However, I think that those that benefit, again, have to have specific needs that are being met. Needs, for instance, in the tax planning and structuring space.
Needs for F1 tickets on the last minute.
Perhaps.
Yeah.
Or even, frankly, needs to just control their worst impulses and instincts.
And their children?
Which would then benefit their children, because the money,
I find that sort of the best private bankers seem to sort of be like counselors to the family.
Absolutely.
When you think about the Swiss names, they've been there for, as long as the kids have.
Absolutely.
I would say it's like very relationship driven.
Yeah.
I think I've spoken to a lot of wealth managers who say like actually the investment performance returns rather are actually not that important, because I think once you get to like 100, 200 million, you're in a wealth preservation sort of mindset typically, unless you're really shooting for the stars, which you probably aren't. But if you've got 100,000 or $1 million, you're still going to be accumulating wealth. So I think the mindset definitely does shift the further you go up the spectrum. I mean, if you're worth 100 million, you could put it into T-bills and live perfectly happily. You know, you don't need
Yeah.
to take on risk. So I think that's the key distinction.
So you sort of there are a lot of people who leave and then become family office and sort of run family office or multi-family offices. You kind of did a little bit of that as well, right? And then you joined a larger one. Can you talk a little bit about, you know, like the flip side of that, which is sort of like the private banker of one, and why that makes where that
Sure.
makes or doesn't make sense?
Sure. First of all, I think you do see, you know, a general direction of travel of many people who may have previously been in the private banking industry, having moved on to either being, you know, working at multifamily offices or RIAs or, you know, as external asset managers. And usually what you do see is these new models embrace a few characteristics that are differentiated from private banks. Typically, more transparency in terms of fee structure.
Yeah.
Typically, more alignment with the client in terms
Yeah,
of
yeah.
how money is charged and how client assets are managed. What I saw myself.
So you're saying you're talking about the mid ones, or you're talking about the sort of the private bankers who leave and start their own shop?
Well, so what I personally experienced was that trying to do a one-man show was a bit tough because
Yeah.
you do need the resources of a firm behind you.
Yeah.
You know, you need custody, you need due diligence, you need brokerage, a lot of things that you're just difficult to do on your own, despite the fact that in this modern day
You
and
need
age,
the
you can
sausage making machine.
much more
You-
helpful
yeah.
to
you can
to
offer
have that
all the
with you.
transparency with no
Yeah.
machine, and then there's no sausage.
So in my experience, you know, go to a smaller firm that's still very client focused,
yeah.
entrepreneurial in spirit, but aligned with clients is where I've landed now, where I'm happy.
Okay. Tim, the industry that you're in is right now going through sort of like it's breaking through, right? Like
Yeah.
you just have to go to your YouTube site, and you know, anybody who's in the podcasting business will be green with envy, hypothetically. But you're doing, you know, it's going great. Congratulations on that.
Thanks.
There's some people who are massive in this space and
Yeah.
are starting to get called out on sort of, you know, calling their own book, giving, you know, advice that is not necessarily, you know, good and at scale
Yeah.
and unregulated. Like, is this sort of financial advisor on tap on the internet the next Vice, if you'd like? Are you going to become the next? In 10 years'
Yeah.
time, are people going to look at your cohort and say, Christ, these guys are as bad as the bankers?
I hope not, but I think they're just like any tool. I think it needs to be used responsibly. You need to really take it at face value and then go and do your own research. So even if an advisor tells you something, you also need to go and educate yourself on the matter before you invest anything. You really need to understand what you're putting your money into, right? So I think me personally, I am trying to be a voice of reason out there,
Yeah.
something that is really just talking about simplicity equals compounding, and it's boring. Because I think coming from the investment industry, all three of us probably agree. I mean, there are lots of people who talk about, "Oh, you need to know this company's got this amount of operating cash flow and it's trading at a 12-time valuation. But I keep saying to people in my industry, 99% of people out there don't care about free cash flow. They don't care about operating cash flow. They just want to make money. They
Yeah.
want to grow their wealth. And the best, most reliable way to grow wealth is in low-cost ETFs. That is just what the data tells you, because 90%
I think you've said
of the
that
large cap,
already.
90%. And I'm going to keep banging on about it. I'm going to keep banging on about it until you both have changed your mind.
Look,
let's bang on about it, because you keep challenging me. So I'm like, let's get into it.
Just for the record, I'm a faithful customer of IBKR.
Yeah, you own
they
an
do
ETF.
not. They're
Okay,
not
good,
sponsoring
good.
this show, and I don't think I own some stocks, but most of them are ETFs.
No, but it's no, I mean, I want to go out there and just get that message out there to people, as many people as I can. And also because financial influencers in the US, it's all very US centric. It's all Roth IRAs, 401ks, and, you know, invest in VOO. No, do not invest in VOO. If you're not American, do not put your money into that. It's
This is
rubbish.
this is because you don't like
Yeah.
anything
No,
that doesn't
it's-
have UCIT before.
Yeah,
it.
if it doesn't have a UCITS before it, no, it does not deserve to belong in your portfolio if you're not American. If you're American, go for it. Go all out on
So what do you
VOO.
do if you don't buying VOO? What
You're
do you,
buying UCITS, European regulated ETFs, which give you a much more tax efficient structure to invest. And I don't care whether you're from
Would
Singapore.
they give you the same access?
They give you the
as
same
VOO?
access. All the underlying is the same. It's just
What, like
structured. It's just
VRWA? or-
VWRA,
VWRA?
CSPX, SPYL. It's all structured tax efficiently. So whether you're from Singapore, whether you're from China, whether
See, and
you're from the UK,
but this is the challenge,
this is what
right?
you need
This
to,
is the
this is what you
challenge.
need to invest in.
The world needs more people talking. I'm glad they have you talking about this
Yeah,
stuff because
yeah.
actually, my retail banking RM never talked about it. When I moonlighted with a private banking RM, they didn't talk about it. They talked about the truffle oil and the
show me
F1.
the incentive. Show me
Yeah.
the incentive. That's what I keep coming
This
back
is
to.
like, or just get good friends, right? That's like. Let's talk a little bit about money, wealth, and advice, good and bad. Zal, what is rich? Sounds like a statement. It's a question. I was sitting down yesterday, prepping for the show with a friend of mine, ex-Googler, went to a big name in Southeast Asia. They IPO'd and on paper they were doing incredibly well, and they've sort of gone south. He defined this to me. He said there are three. I'm going to read this out. There are three kinds of wealth. There's life-changing wealth, or what is popularly known as FU money.
Okay.
That applies to you, as in like it frees you up to do whatever you want to. I can fly business class, go to the Michelin star, whatever I want to do. There is generational wealth, which is like I can do that, and my kid can become a ballerina or something else, whatever. Not that ballerinas don't make money, but last I checked, or fashion designers in my case.
Yeah.
And then there's the third, which is like society changing money, which is sort of stuff that Gates or Peter Thiel has, and you could argue and debate on how they use that, right? Is that the three definitions for you? Like, how would you define rich?
Well, I think I know what you may be alluding to the other day on the All In podcast. They were sort of discussing the same sort of lens.
I may have heard it there as well. Yeah.
Done that. Okay, let me say a couple things. I think that the ability to say, look, for the rest of my life, this is the lifestyle I'd like my family to live with.
Yeah.
And I want to have enough financial resources to make sure that lifestyle is covered. I think that's a terrific goal, and many people, many clients who I engage with say this to us. And certainly, we're here. I enjoy working in this industry because I can say to clients, look, this is what you have to do to achieve that goal. This is what you have to do to maybe save enough and protect enough for your kids to be able to have that flexibility. Now, that amount will differ greatly if you're in Singapore or Sierra Leone.
Yeah.
And whether you are paying U.S. taxes on capital gains or not, So for each woman or man, that amount is going to be at different level, and at different stages in their life will have different needs. But I think the important thing is to go in with your eyes wide open and to be able to say, this is what I want to achieve. This is how much money I'd like to have given my lifestyle needs or given my legacy plans, and therefore I have to do X, Y, and Z to try to hit that goal.
See, this sounds like a very sensible answer. I got $10, $100, and $1 billion. With the three thresholds.
Got it.
But that's a hard and fast rule, and I'm presuming this is not the market segmentation strategy at Avasa.
I think that'd be a good bet.
Tim, if we look at money from the other angle of it, like sort of, it is in the world. The Gini coefficient seems to be expanding. It's becoming harder to make ends meet.
Yeah.
As you study the mass end of the market, what's the point at which people feel like, what are the, like, I was half joking with Zal about this as sort of like the high water mark, but like, where do we go from where you're like, people are feeling, okay, I'm financially all right. Where do they start feeling comfortable? What are the sort of phases at which they sort of said, I'm okay, I can retire? Like, what are those benchmarks that you want to make sure that you are hitting?
Well, I
or
think
are
for
working
like,
towards?
I think for Singapore, a lot of people in their 20s now talk about having 100,000 by 30, right? And like certain benchmarks. But even
Is this the FIRE community?
no, I
or-
think just generally when you're young, because you start out and you don't earn much money, and
Yeah,
then by the
yeah.
time you're 30. But even talking about having $1 million by retirement, and that's not, people are just saying, oh, can I retire with that? And so I think there's a lot of maybe worry about the cost of living in Singapore and
Yeah.
housing and just pricing just generally. But I think for a lot of people, what gets overlooked maybe in the Singapore context is CPF Life, which I've done a video on this previously. If you have CPF Life up to the enhanced retirement sum, which is I think something like $450,000 or $400,000, it pays you a set income for life from 65 at like $3,400 a month. And to meet a comfortable or aspirational tier of retirement where you're talking maybe 5,000 per month or 8,000 plus per month, you only have to invest maybe
Yeah.
200-300.
But I want to just press there for a second, and again, and also widen the aperture.
Sure.
Singapore's super interesting. We're here.
Yeah.
I've heard it's termed CPF millionaires.
Yeah.
Where you
Yeah.
sort of start off early enough. You
Yeah.
can in fact start investing for your kids, and then you
Yeah.
can set them up to be a CPF millionaire. Is that
Yeah.
a thing, or
I
sort
think
of was I?
there's a lot of takes on.
Was I half
Yeah.
asleep in my TikTok stream and saw you?
I think there's a lot of takes
Imagined
on,
you.
There's a lot of takes on how you should allocate, I think, when you're in your 20s and 30s into CPF and cash and or even SRS, right? Does it
Yeah.
make sense at a certain point with SRS, like a supplementary retirement scheme? But I think if you're looking at the CPF and you're looking at the special account at 4%, and you've got a 30-year runway in your 20s to invest cash, right? Should you be topping up your CPF special account at 4%? What's the opportunity cost of 30 years of that delta between 4 and sort of the average of 8% of global equities, right? Nominal. That's going to be a lot. So I think it really makes sense on when you're topping up, and maybe it makes sense when you're in a higher tax bracket. You've got more incentive to top up that 8,000 or whatever it is to your special account, and then you can top it up to higher amounts. So I think it's more about allocating properly and responsibly your asset allocation in your 20s and 30s as you scale your income into your 30s and 40s.
I think I want to sort of because we'll take every Singaporean viewer we've got. But
international?
For internationally, when your country doesn't is not as enlightened as Singapore, doesn't help you.
Use your supplementary retirement scheme if you're earning 2, 3,
What if you don't have a
400 grand?
retirement? When you're a kid in India or
A kid in
China?
India, go and try and put away $100 a month into UCITS ETF, into a low cost ETF.
I
The
thought
product
you'd say
set,
that.
the product set,
Yeah.
again, as I said,
Yeah.
it's very basic. You don't need. Do I need to tell you again? You don't need to be worth 10
but I'm
million
sure
to
we'll
do
ask
well.
you in about 5 minutes time.
Yeah. So then I'm going to drive it into you every chance I get, man.
Amazing. Let's talk a little bit about again, just sticking with the sort of the two ends of the spectrum. What are 1, 2, or 3 common mistakes that you see people make at the top end of the pyramid in terms of investing mistakes?
Okay, I think
we talked about a really non-obvious one. I thought it was interesting about risk appetite.
I'd say 3, Aman. The first 2 are on risk appetite and on people being on either extreme of that spectrum.
Yeah.
So the first is, I've made my money. I just want to protect it. Let's be very conservative.
Yeah.
And sometimes my returns may not even keep up with inflation. So that's a big mistake in my mind, right? Because although that's a natural instinct, to become too conservative, you're really hindering the growth of your money, especially if there's an inflationary environment in which you're existing. And some people have that outlook. Others say, look, I want to take a lot of risk. I made a lot of money. Let's take risk. Let's buy SpaceX. Let's put a lot of money into this venture that my friend is doing in Papua New Guinea, etc. So I think going too far out on either side can be a mistake. I think a measured approach where you understand your risk-adjusted return and your needs, etc., are very important. The third, I would say, is when you get up into that wealth spectrum, you do want to worry about how you're planning your taxes and your estate, because that can take a massive chunk out of your wealth.
Yeah. And that's why they need you guys.
We'd like to think so, yes.
Okay. How about you? For the people who don't have, who have your YouTube account and a couple $100,000.
I heard a really great quote from Morgan Housel a few weeks ago on a podcast. The one thing that's going to make sure that you build wealth is not having FOMO. Not having FOMO is the first one.
Yeah.
Because that is going to destroy a lot of capital throughout your life if you have it.
Yeah.
Second is this need to do something when markets are down or when people are shouting, when you're seeing headlines. I've learned through 20 odd years of investing, doing nothing typically leads to a lot better results. Staying put, staying invested, not churning. People churn way too much, go through too much garbage, churn into the next product, recycle into whatever, and then again, show me the incentive. I'll show you the outcome. Why do they churn?
I want to say this. You both said the same thing with one thing different. You both talked about fear and greed, FOMO, and
because
greed.
Everyone's the same. They're human.
But the thing that you're saying is get advice.
It doesn't matter whether they're
incentive.
worth. It doesn't matter whether they're worth 100 million or 100,000. People have the same emotions.
No,
and
but
it's
but
very
this is.
emotionally driven.
I'm just like actually that you're 100% right on that. But I think that's the difference. What I'm saying is that you like actually what you're again. I'm going to put words in your mouth, and you can disagree with me. You're saying like actually it's very unlikely you're going to get good advice at your level. So
no, not at that. Not at that level. No, I never said that.
So where do you get good advice?
You go out and learn it. Because anyone can do it well. There's this perception, because the finance industry puts it out there, that you can only invest well if you have some inside knowledge or you have someone with access. And that's the biggest lie out there. It's a lie. It's not true, because you can do well. But again, selling ETFs, I'm going to keep saying it, it's not profitable. And it's just not. It's just a fact. It's the data. So I'm just telling you out there that it's more about, that's how I've come to realize, and I want that message to get out there to more people, that you can do well. You just have to control your emotions. You have to keep it simple. You have to be consistent. You have to be disciplined. Do all those things. You'll beat 99% of people out there.
So staying with this fear and greed theme, let's shift gears and talk a little bit about the age of AI and everything that comes with it. Like I think last week, I forget which day it was 4 days ago last week. Last Friday, right?
Yeah.
Something incredible happened, right? Like, I mean, a company IPO'd, went straight to $2 trillion, created SpaceX. They created the first trillionaire in history, in Elon Musk, who himself said that if you had told him that would be the outcome, he'd tell you that you were smoking something. That's his words, not mine. So, and he can say it,
and we can imagine.
And he's got society changing money now, right? But like, this is a company that has got a. If you believe it, it's got like, and you got all the biggest brands and leaders in financial services talking about it. It's a $28 trillion opportunity if you believe everything, but it's also a company that makes $5 billion in loss, right? Is this the classic example? What do you tell your customers when they're saying that FOMO's kicking in, saying, "Hey, my mate got in early"? Do you get them? What's the answer? Get them early into SpaceX? Don't get into SpaceX right now.
Okay, so you've just asked a couple of different questions, and I'll try to answer them.
Could you just wrap up the whole economic future and investing and do that in like 2 minutes?
First of all, we do our best to get access to our clients to interesting private opportunities.
Yeah.
And so that's something that we try to do. You can't always tell whether those opportunities are going to pan out or not,
or whatever,
or whether you get the allocation. I'm not at liberty to say whether we're actually active in the SpaceX deal itself, but we've been active of late.
Okay.
Now, what do you say to somebody if they come to you?
Were you in Texas last Friday? No, sorry.
What do you say to someone if they say, "Hey, SpaceX is a great deal at $2 trillion"?
Yeah.
I don't know. And I think we'll find out in the future. Now, one reality is that SpaceX and all of these large companies will be part of indices, and we will get access to them when we invest in our ETFs, etc. So from a certain perspective, you don't need to chase the individual name, because it will, in all likelihood, be part of a global index, a US index, etc. And you'll get exposure to it as an investor.
So what you're saying is my VOO that he hates has SpaceX in it already, or will do soon.
It will at some point.
And the UCITS
Yeah.
do too.
Yeah,
But
yeah.
what's your take
I
on
agree-
it when like
I agree with
the
Zal.
get rich quick kind of ideas
Well, I
when
mean,
people come to you with that?
It's rubbish, isn't it? I mean, get rich quick thing. That's not the way that you should be thinking about growing wealth, right? So, but Zal's right
But the
in terms
crypto
of.
bros will tell you that that's.
But these crypto bros, they just put their money in Bitcoin, and then it seems like they're geniuses. I don't know. I don't find that so compelling. I don't think they've done anything super smart. They've just managed to put their money into a coin that's done well. Okay, that's good for them. But don't try and make it out as though you've done something really special. So, I mean, I think personally, I agree with Zal in terms of you're going to get exposure to it anyway in an ETF at some point. I've done a video on this recently, actually.
Yeah.
I think sort of like 10, 15 days off the bat, you're going to be only exposed about 0.05, 0.6%, 0.06%. So less than 0.1% in a global sort of tracker, right? Like VWRA.
Yeah.
And S&P won't allow it to go into the index until the end of 2027. Well,
Correct.
sorry, or at the earliest in June 2027. But I think for investors, the private placement and what I love about public markets is you are on the same playing field, whether you're Temasek or just a guy who earns $3,000 a month, because you are buying the exact same underlying.
Yeah.
What I don't like about private assets, because I see private assets being hawked a lot, is that there's going to be preferential access. They might get an allocation. You might not get an allocation.
But
that being
okay, so
given.
this brings
it's more like
this is a segue.
there's not
Actually, a
that-
beautiful segue to the
Yeah.
next question I had for you. That's changing, right? Tokenization, miniaturization
Yeah.
is coming. So you could buy access
Yeah.
to the Carlyle Group now. Once upon a time, the reason I told you the story about mutual funds is that mutual funds had a very exclusionary
Yeah.
criteria of $200,000 and more. Then came ETFs and took the floor out of that.
Yeah.
That's happening in your the field you play in. So question to both of you. I'd love to get your views on tokenization. Does that excite you? Does that say that that's more instruments that can give people access? And then does that worry you because you're like, oh my God, like the one bastion that we had is sort of like getting blown out?
I personally, it scares me. Like if you were talking about a liquid vehicle backed by illiquid assets, I couldn't think of a worse recipe in terms of like an investment proposal for the average investor. So in that perspective, it's something I wouldn't touch with a 10-foot pole. But that's me personally, So I think it depends on what people would like
But again,
to.
But then Zal, it goes back to your question, is it about risk appetite, or like if you've got $10,000 of spare cash versus $10 million of spare cash, does that change things?
I mean, look.
Sorry, I just asked you a second question, but you might want to answer the first one first.
Very
yeah.
quickly, answer the first question. Do I like the idea of democratization of private assets, that the little guy can get access to something that heretofore only the big guy could get access to? Absolutely, I like that idea. Now, are you going to execute that in a way that's fair and transparent? That's another question.
Yeah.
Tim just pointed out, this mismatch sometimes between reality and liquidity expectations. We saw that recently in the private credit space. People thought these semi-liquid funds were essentially pretty liquid. They didn't focus on the semi part of that phrase, and they realized that, oh my gosh, there are gates, you know? So this was an example of maybe misselling or mismatched expectations. Okay, but I like the idea of democratization of private assets in general if it's done properly.
So I did an exercise recently where, and I wrote about it. Like I took my, IBKR. So I have most of my stock there. So I gave it to Claude, and I said, I also gave it my blood work. Different story. But I'm all in on AI, as you can see. But I gave it to them, and it came back with like a really. Actually quite a intelligent view of my, not entirely correct, but but almost like 90% accurate. And it gave me so there are people who are today going and just swearing by that. That worries me. But for me, in that situation, it gave me a bunch of questions to ask my financial advisor, whoever that is, whether it's talking to you guys, talking to the actual people who are paid to sort of do that, Are we heading to a situation where people come in and with annoying doctors and have self-diagnosed themselves a little bit? That that in this case could be a good thing? Let's start with you, Tim, and then how that works for the.
Yeah, I mean, I
Ultra
think
high
it's
net worth.
I think it's a great tool. Again, it's how you use AI, right? I mean, I think there are so many cases where people just outsource their brains to it, whether
Yeah.
it's investing, whether it's self-diagnosing, whether it's how to write something, and then just sending out. I've seen emails where it's, you got the next prompt in the email, and you're like, geez, come on, could you not at least have like proofread that email before you sent it? But that kind of example, it's
AI is
just
making
almost
people lazy, I have to
so
say.
so it's almost like don't outsource your brain and proof check things, make sure you double check the data, make sure
Yeah.
it's correct. And I think if you do that, it's a great tool to save you time, and it can help explain concepts from the investment perspective in a much more easy to understand, digestible format. So I would say, yeah, it's great. But when it comes to your asset allocation, your goals, all these other things that it needs to take into account, I think there is still a value add to a human element and a
Got it.
relationship there. Yeah.
Totally agree.
Which one? Wait, Tim.
We are going to be.
Either you're getting tired or you're getting honest. I don't know which one it is.
we're going to be using AI more and more, whether that be companies using AI to become more efficient, individual end consumers or consuming companies using AI to sort of optimize and understand their product set,
Yeah.
and therefore be able to ask more intelligent questions. Those are realities that are sweeping across all industries, and I don't think financial services are going to be any different or exempt from that. So that's a reality that we're dealing with.
Yeah.
And I think that AI is, it's going to be intelligent firms and firms that are farsighted are going to harness it effectively, but to continue to build on what humans can do that machines cannot. I believe it.
I think that's a whole nother topic for us to come back on.
Yeah.
Listen, I wanted to do something a little bit fun as we come to the wrap on this thing. I want to play a quick game with you. It's a sort of it's a first for us. It's a rapid fire question. You guys have kept it pretty tight, but here is where I need like monosyllabic answers and not grunts. So I'm going to ask you like 10 questions,
All right.
and I'd love to get your quick takes on them. You can go in. How do we want to do this? We could go in any order, right? Like
Yeah.
fastest
Go in
finger
any order.
first.
Sure.
Okay. One word is now a good time to buy.
Always.
Yes.
Buffett or Jim Simmons Renaissance.
Buffett 50 years ago, Simmons today.
Buffett.
And in terms of Buffett or Ackman,
Buffett.
Buffett.
would love to have a follow-up question, but I'll break my own rule. The best piece of investing wisdom ever written, Zal.
Start investing early.
Stay invested.
Okay. Gold, ancient relic, or honest money, Tim?
Honest money.
Honest money.
Honest money. Bitcoin is a serious portfolio. Yes or no, Zal?
Is your question, is Bitcoin...
I'll read the question again.
Okay.
Bitcoin is in a serious portfolio.
Can be.
Can be again. Sizing. If it's 100%, no. If it's 0.5%, yes.
Ooh, you're softening up too.
Bitcoin and gold.
Yeah, I know. At the end of this, you'll sell a mutual fund.
Never.
Schroders growth fund. Here comes Tim. You want to announce something right now, Tim? The most overrated word in investing, Tim.
Alpha.
Risk-adjusted return.
Okay. I wonder how many people in asset management have their dogs called Alpha. The most dangerous word. Oh, we did that. Sorry, chasing alpha. Oh, we did that as well. So let's keep going.
Yes.
Renting versus owning your home.
Owning because it's going to give you peace of mind.
I'd say owning, but not property as an investment.
Okay.
Smart guy.
Yep.
Comments.
The one asset, Tim, you would hold for 100 years and never look
Equities.
Equities.
back. Okay. And I think I know the answer to this, but wait for the dip? Yes or no, Zal?
No, just buy today if you're a long-term investor.
Agree. No, buy today.
Now, on that note of dollar cost averaging your way to the future, I want to thank both of you. This has been, I think you've been more brave than I imagined. I really appreciate the candor. I appreciate the flex on timing and sort of making this all work.
It's great being here.
Yeah, thank you for having us.
So to everyone listening, whether your login currently lives or to everyone listening, wherever your login currently lives, if this made you think, send it to somebody who needs it. Subscribe, leave a review. It genuinely helps a show like ours, as Tim knows. Stay curious, and to these two men who have taught me that you can leave home and still arrive somewhere, stay rootless.
Thank you.
Thank you.
Thank you.
Thanks.
I've got 5 minutes. Can I shoot the first, that legal disclaimer? Yeah, and we can add that in?
Yeah.
Sorry.
Go for it.
Sorry, and this is the
Please,
transactional part.
please,
I just
please.
got to get in. I've got 5 minutes and... Oh, shit, I did this. Okay, so Zubin is the one who normally reads this legal bit, but I'm going to have a go at it. So here it is. This is for information and entertainment only. Our views are our own, not those of anyone we work for, and none of it is financial advice. Fair warning, there is more real investment talk in this one than we usually allow ourselves. So if you take 3 jet-lagged men and argue on a podcast and turn that into an actual portfolio, who are arguing on a podcast and turn that into an actual portfolio, that's not on us. Stay smart. That's it. Yeah.
Cool.
Thank you.
Thanks.
Thank you.
Awesome, man.
That was
Thank you.
fun.
That was fun.